Well, let's talk Chapter 4. As you can see, Chapter 4 is all about cash and your savings. You can definitely just read this right here to get some information about what is considered cash. It's not just cash in your pocket. Other things are very similar to cash and spend the same as cash. It kind of just explains that. Here's all of the learning objectives we'll be talking about for Chapter 4. And then the facts and fantasies, I'll let everybody look at those on their own. Okay, so for Chapter 4, we're talking about cash management. Basically, that day-to-day part of how much cash do you have. Of course, we know that cash is very liquid, and so we're really thinking of cash or near cash items that are considered to be liquid assets because you can spend them easily. Cash management ensures adequate funds for your household use and for savings. So we're really just thinking about how do I manage the day-to-day process of having enough cash to meet my daily needs, then hopefully setting something aside for future needs. This just gives you an approximate rate of return. They're minuscule, absolutely tiny. My checking account gets me 0.05%. And my savings account gets me 0.1% at my credit union. So it's very, very small right now. We're in a very low interest environment. And so savings of liquid investments right now are very small. And right now, as I mentioned, we're really at very close to all-time lows when it comes to interest rates. There's many reasons for that. Really the biggest reason is after we had the 2008 recession and some almost collapses when it came to some banks and whatnot, is that the government, the Federal Reserve, lowered interest rates as much as they possibly could. And so, and the reason for that was to stimulate the economy, to encourage borrowing, to make borrowing less expensive, and basically allow businesses that need to borrow to function and to build stuff and make things to be able to do so at a lower rate, and basically to be able to stay in business and so on. So that's what you have going on. And so with low rates means borrowers pay less on interest, but savers earn less interest. And so that's kind of where we're at right now. But you know, a low interest rate is good for people who are looking to buy a home. Mortgage rates are very low. Car rates are very low. So there's really some reasons for that. However, you know, from the borrowing side, low rates are good. From the savings side, low rates are not as good because it does not encourage savings because you make less than inflation. You know, look at those interest rates that we have right here. Inflation's been around 2% roughly for the last 10 years or so. And so if I save at these rates, I'm not even keeping up with inflation. I'm still losing earnings power. So, the power of my investment goes down with inflation. It's eroded by inflation and does not get to keep up with at least the interest rate that I'm making. So that's what it says right here. The inflation adjusted rate may be negative, which is what we're at right now for those types of investments that we showed you. And those other investments, of course, you can use to make more money than 2% or so. But right now, if you're looking to keep your money very liquid, you're kind of stuck at earning a very small interest rate. There's two types of financial institutions that will accept deposits from a saver. Of course, we can all probably think about a bank first. So we're thinking commercial banks, savings and loans, savings banks, credit unions. They're all essentially doing the same thing by accepting deposits from customers and then giving out loans. You also have non-depository, which is stock brokerage firms and mutual funds where you can still put cash in and they will gladly accept that cash and they will do something with that cash. They will deposit that and give you a rate of return very similar to the rate that banks have. So you still can do that too. So as I mentioned, banks, commercial banks offer savings accounts, checking accounts. A lot of banks offer some kind of very low-cost structure or free structure. Here in Sioux Falls, we have many students, and maybe some of you taking the class right now that work at First Premier. And First Premier offers totally free checking, no strings attached. Obviously, if you have an overdraft or something like that, there's some fees, but otherwise there are no fees whatsoever besides paying for your checks and so on. So just some things to consider and think about when it comes to banking. Now, most people bank at what we call the brick and mortar bank that you see right here. Typically it's a bank that's fairly close to where you work, where you live. Typically it's a bank, I'm guessing a lot of you are banking wherever your parents have banked because a relationship was there. That's very common. There are, though, also internet banks. Which are online commercial banks, which are also becoming very popular, and quite often will actually offer a little bit better interest rates because for them operating costs are lower because they don't have to maintain physical locations by being an internet-only bank. There's some limitations, of course. You can't just go and talk to somebody face to face. It would have to be over the phone or email or something like that. So, but that option is available if that would interest you. And of course, all banks today, brick and mortar banks too, have a very good and robust online presence. They just have to. Other types of banks are savings and loans. Primarily, they're involved with home loans and home improvement loans. A savings bank is very similar to a savings and loan, but primarily is located in the New England states. Just kind of be aware of some of those. These are some of the types of things I can throw at you for a quiz or test question. A credit union, I'm actually a member of a credit union. I've been on the board of a credit union here in town for a while too. I'm not currently on the board, but I have been in the past. They're nonprofit, they're member owned, so to be a member you just have to have a savings account open for a very small amount. And different credit unions serve different types of customer bases. Some are just based on geographics. I belong to Sioux Falls Federal, and as long as you are living in Minnehaha County or Lincoln County, you can be a member. That's the only requirement. Other ones are more based on occupation, potentially religious organization or fraternal order, or it could be based on being within a certain union or something like that. So just kind of based on trying to meet the needs of a certain group of people. And so because they're nonprofit, they typically pay a little bit better interest because they're not having to pay dividends to owners, but they offer savings and checking and home loans, bank loans, any kind of loan you can think of that any other bank would give you. Typically a credit union will also give you. Sioux Falls Federal, their biggest portfolio of loans actually was cars, mortgages being second, but it's not uncommon. Non-depository financial institutions would be the stock brokerage firms. Quite often, if you have some kind of a trading account like an E-Trade, a Scottrade, there's quite a few other ones also. They offer savings. They don't really offer loans necessarily, but you can put your money there and save it. You could get a credit card or a debit card on that too, or even some check blanks on that too. So money that you give them would go into some kind of a money market mutual fund, but it's available for you to spend if you need to. Now, typically that's not what most people are doing. Money they put there is money that they intend to invest, but there is the option to use it through a debit card or something like that. Mutual funds, we'll get to that in the future. It's a way to save money, to invest by using a portfolio of stock investments and other investments like bonds also. We'll get into those in a future chapter. And then other non-depository financial institutions include life insurance companies and finance companies. If you have life insurance, depending on what kind of life insurance it is, there's a possibility that there's a savings component where you're earning some interest, and that could be withdrawn. Potentially, some of it can be withdrawn for use and so on. Insurance on your deposits. So money in your bank account is insured. The government requires that to be so. It's protecting the consumer essentially from bank failures. Depending on what kind of a financial institution you have your money in, would determine what government regulation, what government organization is kind of overseeing that. But basically, you are insured for up to $250,000 per depositor at a bank. So if you have two accounts, checking with 200,000, savings account worth 100,000, the insurance limited to 250 per the depositor. Plus a total, so some of that would not, in this example they're giving us here, some of it would not be insured just because it's per depositor. Now, if it's a joint account though with two depositors, then your amount doubles. So it's per depositor. So if it's a joint account, you have 500,000. If it's a single account, you just have 250,000. So checking accounts, I think everybody's probably fairly aware of what a checking account is. I would guess the vast majority of you at this point in time have a checking account. Essentially, you're writing a check or using a debit card or making a cash withdrawal and your money's coming out. Usually, most employers nowadays do direct deposits, so your money is being paid directly into your bank account. You're telling your employer, here's information from my bank account, and that gets deposited immediately into your account, and so on. So just kind of just thinking it from that perspective, how you take care of it. Savings accounts are more what they call time deposits. Interest rates are a little bit higher, but not much. As I told you, my checking account, I get 0.05%, and my savings is double that, a whopping 0.1%. So a lot of accounts nowadays do pay interest. Again, typically it's not very much, but you can see there's a list here of checking accounts that will pay some interest. Now, some banks have minimum requirements of money that must be in the account before interest will be paid. Others are saying, that could be a very large number depending on the bank. I do know that there's a bank in Sioux Falls that offers 2% on checking. However, you have to have like 50,000 in the account or something like that. So, you can get some interest, but you have to have so much in the account. So not many people are going to be able to qualify for that. You also have what they call asset management accounts and a comprehensive deposit account that combines checking, investing, and borrowing activities, really offered primarily by brokerage firms. EFT, electronic funds transfers, I think everybody's fairly aware of those. Really, probably one of the most popular ways that money is moved within our economy right now, due to automation, computerization, and the internet, of course, is it's very easy to set up EFTs personally. All of my regular routine bills are taken out of my checking account. I basically am telling the utility or the insurance company, take it out on this day of the month, and essentially they just send me a remittance advice, or they send me something saying here's the amount that we're taking out. Of course, debit cards have become very, very popular. With a swipe, the money just comes right out of your account. And of course, everybody's very aware of what an ATM is. So you can just go up to an ATM, put your card in, enter your code, and withdraw some money from your account. So pre-authorized deposits and payments, I've kind of already mentioned a few of these. Deposits would be your income. Almost all employers prefer that they do some kind of a pre-authorized deposit into your account. It's just quicker, it's easier. You don't have to get a check and take it to the bank and deposit it. The money just goes right into your account. A lot of companies that will make payments to you regularly, insurance companies, pension companies, Social Security, will want to do the same thing, just make automatic payments right into your account for you. So money, it could be money coming in or money going out. And I mentioned for me that I do, that's exactly what I do. So maintaining a bank account, or a checking account I should say, the importance of doing a regular bank reconciliation. So I just want to encourage everybody from a personal perspective. One thing that you should definitely do is, if you have a checking account, is look at it online every day. If you've got your bank account app on your phone, would probably be the best, easiest route to go. Log into it once per day and just make sure that anything that's gone through your account are things that you've done. If you used your debit card, if you've written a check and you see it clear, your money coming in for paychecks or whatever the money in that's coming into your account, just look at it every day. So if there's something funny that went through, you can immediately take care of it. When Target had their data breach a couple of years ago, I think it was like October, November of a holiday season, and my wife used her debit card at Target, and about a week later we had this weird charge from Mexico go through our account, and I immediately trotted to the bank and said that's not real, and they took care of it for me. So you got to be very careful about things like that. So it's always good just to check your account daily, just to make sure nothing funny went through it. So if something funny does go through it, they can immediately call your bank and take care of it. So basically, banks can make errors, you can make an error, and generally you need to report that within 60 days. So if the bank made an error, you got to tell them within 60 days. And the only way you know that is to do a bank reconciliation. So it mentions here Exhibit 4.6, and I'll show you a bank recon here in a moment. But that's really what your homework will be for Chapter 4. We'll be doing a bank reconciliation. So just be aware of that and be prepared to do one. Then also, what's nice about automatic transfers is you can just tell the bank to say, every month put X dollars from my checking into my savings or some other account, whatever that account is. So you can set up automatic savings programs to move money from checking to savings, or if it's within the same bank or a different bank or whoever it is, you can make that happen very easily. Interest, of course, by having money in the bank, you are earning interest. If you have a loan, you're paying interest. But for a lot of your investments in the bank, quite often you are saving and earning some interest, even if it's not very much. Compound interest is basically earning interest on your interest. And simple interest is interest only paid on the initial amount of deposit, so just paid once. The effective rate of interest, called the EAR, or the EAR, sometimes you might see that. The annual rate of return that's actually earned or charged during the period for the funds are held or borrowed. So you can do this from both sides, from the borrowing side or from the savings side. So basically the formula is the amount of interest earned divided by the amount of interest invested or deposited, and then that will give you your actual rate of return. So in this example, it's buying a bond, $1,000 6% bond for $950. Interest received is $960, and you spent $950 on that. Divide 60 by $950, and you have an effective rate of 6.32. So just some things you can do to earn interest on your savings. A certificate of deposit, typically a long-term document. You can get them for shorter terms, 30 days, 60 days, 90 days. Or for up to a lot of years. It says right here 7 days to 7 years. The longer the term of a CD means the more interest that you will earn, but you're locking up your money. So if you want to try to get that money back early, you're giving up any interest that you would have earned. US T-bills are short-term, issued by the federal government. Series EE bonds or savings bonds that you can buy in various denominations. And then a savings bond, a Series I savings bond, would have a fixed rate and have some inflation protection with it also. Okay, so Chapter 4, I think you'll find it'll be a little bit easier. The tax chapter was probably a little bit tougher one. This one's a little bit easier. But it's primarily then about doing the bank reconciliation. So in my.usf, under the download section, this Excel file is there, and it is doing a bank reconciliation. And you might want to use this to help you do the Cengage Now homework. So there's just two problems in Cengage. One of them is doing a bank recon, so just be aware of that.